Later CPA and Associates, accounting the grapevine mates.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. This week we are talking about the Section 127 Education Assistance Program, helping your employees pay for school. Now, I know the name sounds complicated, but the idea is simple. A business can create a written plan to help employees pay for education costs. If the plan follows the IRS rules, the employee may receive up to $5,250 per year tax-free. In 2025 and 2026, the employer may also generally deduct the cost as a business expense. This can be a useful benefit for practices that want to support employees, help with training, and improve retention. Now, why does this matter? Well, education is expensive, and employees may be paying for college or graduate school or continuing education, books, supplies, or student loans. A Section 127 plan lets the employer help with those costs in a more tax-friendly way than just giving a bonus. For example, if you give an employee a normal bonus, payroll taxes and income taxes will apply. But if you reimburse qualified education costs under a proper Section 127 plan, up to the annual limit may be excluded from the employee's taxable wages. That makes this benefit more valuable to the employee. Now, what does this plan cover? Well, a Section 127 plan can cover many different education-related costs. Some good examples are tuition, fees, books, supplies, equipment, undergraduate classes, graduate level classes, and certain student loan principal and interest payments. Now, the education does not always have to be job-related. That's one of the really helpful parts about this rule. The IRS says the payments may be for undergraduate or graduate level courses and do not have to be for work-related courses. So this is broader than just paying for a work seminar or continuing education or training. It's bigger than that. Now, what this plan does not cover usually are things like meals, lodging, transportation, any tools or supplies that the employee keeps other than textbooks, and of course any sports, games, or hobby courses unless they are related to what's being done and the degree. So the tuition for a class would qualify. The hotel, meals, or gas to get there usually would not. Now let's talk a little bit more about the limit, the $5,250 per employee per year limit for 2025 and 2026. That limit applies to the education assistance and student loan assistance combined. So for example, if an employer pays $2,000 towards an employee's student loans, then only $3,250 remains for other tax-free education assistance that year. Now, the IRS says that $5,250 amount will also be adjusted for inflation after 2026, so it won't be stuck there. A couple key points about having a Section 127 plan. The plan must be written. This is not something that an employer should just casually handle. A written plan should explain things like who is eligible, what expenses would qualify, the annual limit the business would contribute up to, how employee requests reimbursement, what documents employees must provide, whether student loan payments are included, and whether part-time employees may qualify. Now, to make this easier, the IRS has published a sample Section 127 plan that employers can use as a starting point. That tells us something important. The paperwork really matters. A business should not simply pay a tuition bill and then try and call it tax-free later. The plan should be set up first, communicated to your employees, and then followed consistently. Now, the plan must be fair. A Section 127 plan cannot be designated only to benefit just the owner or the highest paid employees. The IRS says the plan cannot discriminate in favor of highly compensated employees. The employer also has to give reasonable notice of the plan to eligible employees. So in plain English, that means the plan should be a real employee benefit, not just a backdoor way to pay personal education costs for the owner or the owner's family. Now, let's talk about how this benefit, the Section 127 plan, can benefit owners, but the more restrictive rules that apply. So this is where a small business owner needs to be very careful. The IRS says that no more than 5% of the total benefit paid during the year can go to a more than 5% owner, shareholder, or spouse or dependents. This rule can make the Section 127 really hard to use in a very small business. For example, if the owner is the only employee, the owner cannot receive Section 127 education assistance because of that 5% benefit limit. If you want to read more about that, IRS Publication 15B says more about that. Now, also remember, the child of an owner is also not automatically eligible just because the business has a plan. The child would generally need to be a real employee doing real work, and even then, the owner family benefit limit, that 5% limit, still matters if the child is that owner's dependent. So this can work well for a business with a real team of employees, but it may not work well for an owner-only business or a business trying to benefit only the owner's family. So let's give a simple example. Let's say that a therapy practice has several employees. The practice creates a written Section 127 plan. The plan says eligible employees can be reimbursed for approved tuition and fees and books and supplies and student loan payments up to the annual limit. One employee uses the benefit for graduate school, another employee uses it for student loan payments, and another employee uses it for classes that help build business or clinical skills. If the plan is written correctly, offered fairly, and documented properly, this can be a strong benefit for the team. But if the practice only uses the plan to pay the owner's child's tuition, that is where the task risk goes up and probably wouldn't be allowed. So let me leave you with some practical tips. First, put the plan in writing before paying out benefits. Use the IRS's sample plan as a starting point. Just Google IRS Section 127 plan. Tell your eligible employees that this plan exists. Require proof of their education expenses. Keep the annual limit in mind and in front of everyone. Decide whether that student loan payments are to be included. Do not favor only owners or high-paid employees, and be very careful with spouses and children and dependents of owners. Now, also review the payroll treatments before W-2s get issued. We want to make sure these things are reported properly so they don't create more tax. Just a couple closing thoughts to leave you with. A Section 127 education assistance program can be a great benefit. It can help your employees pay for school and reduce student loan stress and feel supported by the business, but it needs to be set up the right way. The key is this: it should be a real employee benefit, not an informal reimbursement or a personal tax strategy for the owner. When it's used correctly, it can help the employee and the business. When it's used casually, it can create payroll and tax problems. Critical thinking question for you. If your business offered education assistance, would the plan truly support your employees as a team, or would it mostly benefit the owner or the owner's family? Next week, we are going to be talking about charitable planning that actually changes the tax results. So don't forget to like and follow and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.